Good afternoon. My name is Jon Meyer. I am the person that runs the wealth management side of BGM. And today I will be talking to you about diversifying business wealth. As we get started, just as a reminder, if you have questions, there's a Q&A box. You can drop a question in if you want at the bottom on your bar, and I will see it pop up. I have another screen up here, so feel free to ask any questions you want along the way. Otherwise, we are scheduled for an hour. I'm going to probably end it shorter than that on purpose because I tend to like to make sure we don't go over. But with that, let me start with a quick um, disclosure that just want to remind everyone that everything I talk about today is not meant to be specific to any individual. So if you have general questions, feel free to bring them up. But otherwise, I would check in with your current advisors, or if you want to talk to me afterwards, there will be a final slide, obviously, talking about how you can communicate with me. With that, I also want to bring up BGM as a group has a lot of services available. So today I'll touch upon several different things when I talk about how to diversify things, and any one of our different groups might be engaged in how that plays out. So I just wanted to bring up this fact that we do have many different services here, so we can go deep with the business owner on many issues. With that, I want to start with today's agenda. I'm going to basically break this up into 4 sections. The first section is going to be talking about why this is important, because I don't think enough people take the time to think about how they approach the the wealth that they've built in their business into their personal life. So I'm going to talk a little bit about why this is important, to diversify away from the business a little bit. Secondly, how to start with the end in mind, because at the end of the day, that becomes a bigger issue when you come to the sale of a business. Third, specific strategies that are geared towards your personal side of life. And then fourth, how to prepare to sell a business. So this gets into, 3 to 5 years before you actually want to sell. So with that, let's talk about why this is important. So the reason I would like to talk about why diversifying away from the business is important is because I've just seen too many scenarios where people have issues that come up. Rainy days do happen. And I think one of the biggest things that I see is health. For the most part, people, whether they realize this or not, are probably dialed in on many health issues, sometimes 20, 30 years before they actually have the problem arise. And so from our standpoint, we tend to see health become an issue for somebody based on all kinds of previous decisions someone's made. And that means people sometimes get sick younger than they think. So from our standpoint, I just want to bring that up. Health becomes an issue all the time. People just don't really think it's going to happen to them. Secondly, lawsuits can come into play. I've seen this happen too, and I do think that this is a sad thing, but it does happen. The third is economic downturn. If you think about what happened, for example, with COVID, COVID changed everything, and there were certain businesses that suddenly had issues because they were set up to sell a certain way. Just take your standard restaurant. An average restaurant, if they were set up to handle takeout, such as a pizza joint, they probably did just fine. But if they weren't set up for that, they had to scramble, and in many cases, they ended up shutting down. So I do think economic downturns are more often than we think, and we're just not always focused on how that plays out with plan B, plan C. Finally, natural disasters. We're not talking about anything probably right now here in the Midwest. If you have business assets elsewhere, it could come into play. particularly on coasts where you might deal with hurricanes or other issues. But natural disasters can come into play. The second thing I want to talk about when we talk about diversifying is return on investment. This is important because most business owners are going to basically look at this from a risk perspective. If you take all your profits and plow it back into the business, most business owners will say that they have probably an 85% chance of understanding how those dollars back into the business will grow and build a bigger pie for them. It's kind of different when people finally sell their business and want to get in, or may not want to get into the stock market. The stock market is not under your control. And so what we see sometimes is people say, well, yeah, but I don't know what the returns are going to be. At least with my business, I kind of knew what the returns were going to be. And I think that becomes an issue. So from a standpoint of return on investment, there is some feeling that that is knowable by the business owner. The problem is bad years happen. And when bad years happen, sometimes that can wipe out many, many good years. And I think that's the biggest thing that I want to point out to most people is we have to be thinking about the 1 year that's bad. Does it wipe out 3, 4, 5 years of good? And how do we diversify that problem away? I think that's one of the biggest things that sometimes gets missed. So when it comes to this control question, there is a positive and a negative. And I want to, I've already kind of talked about the control question, but I want to touch upon this negative. If you don't build cash outside of your business, you basically are going to have a huge problem in the business, because what happens down the road when something does go wrong is you're forced to make decisions in the business based on your personal life. And if you have cash reserves on the side, you can choose not to take a salary and start making decisions that help. But if you don't have cash on the side, then you have to make decisions that potentially lead to you having to fire employees, potentially stop investing in the business, buy new equipment, whatever it is. And what ends up happening when people stop spending money in downturns on a business is that when the upturn suddenly comes, they're not prepared as well as some of their competitors to grab that upturn and ride that wave higher faster, because they haven't been spending on the business in the downturn. Sometimes downturns are the best time to think about how can I invest in the business, because on the back end, it's going to have a bigger ROI. This all comes back to personal cash reserves. If you don't have them, you can't make those decisions. And I saw this a lot in 2007 and 8. I saw it in COVID as people had to make certain decisions. You just got to be willing to take some cash out and put it elsewhere so that you have some kind of backup, which brings me to this idea of thinking small. I think business owners by nature, and I'm a business owner, so I get it. We think big. We think like there's a big payday at the end of the tunnel. We'll eventually sell our business, have this big payoff. The problem is that bigness gets in the way of sometimes thinking small. Sometimes thinking small actually means pulling money out along the way in small chunks, whether it be in retirement plans, which I'll talk about in a little bit, putting a little bit in cash, buying some insurance, things that in the long run could protect us from downside. But the second thing it does is it protects us from our final number being wrong. If you only think big, and I've seen this happen with many business owners, if you only think big and then you decide you have to sell or want to sell and you don't get the asking price you want, you might not be able to provide the lifestyle that you want for your family as you enter the next phase or retirement, however you want to call it. And I think that's a big deal, particularly if you're forced to sell it, because you could be forced to sell it if your health changed or something else happened, right, where the business is struggling. And so that asking price, everyone assumes it's going to be whatever you want. And the reality is it's not what you want. It's going to be some number. And sometimes we got to think about what that means. And I'll touch upon this in a second in a different slide. The second thing thinking small does, though, it does give you money to fall back on so you can make better decisions as a business owner while you have the business. And the third one I'm going to point out is family harmony. I don't think enough people really give credence to the fact that your spouse is in the business with you. They're in your mind while you're sitting with the board making decisions, whatever that means. If you decide to save money on the side and then this business has struggles, your spouse will be your biggest advocate. If you don't save money on the side and your business has trouble, your spouse is going to be the most negative person in your life. And I think that that's a big deal because your spouse oftentimes is the one that has to put up with the extras, like we have to still pay our mortgage, we still have kids that want to go to soccer camp, we still have all this other stuff. And I think we as business owners don't always think about how our spouse plays into whether or not our business can be successful. So I want you to start thinking, quote unquote, small a little bit more when it comes to how do I take money away from the business in small chunks. You don't have to do huge, but some chunks. You give yourself a little more flexibility on the long run. Which brings me to my second issue, and that is start with the end in mind. And when you start with the end in mind, what I want you to think about is ultimately, what do you and your family need as a final number so that you can have what you want for, we'll call it retirement, but it could be called the next phase of life. You tell me. I don't think enough people think about what their final number is going to be. And so they end up just living life saying, well, I just need more money, more money, more money, not knowing what that means. This is especially important when you get to the point where you want to sell the business, though, because what you think you need out of the business for your own purpose, sometimes our own egos, versus what your family needs to just have a comfortable lifestyle are two different things. Sometimes that business sale, quite honestly, can't provide for your family the way you thought because you didn't save enough outside of the business. And I think that becomes a really big issue. So I think planning for what your number is has to happen way sooner. I will tell you that this is a number that my wife and I have had in our minds, and it has changed over the years many times, but we've had in our minds for 25 years. Because I think you have to have some way of measuring whether or not you're hitting what you think you're hitting. The second concept with that, with starting with the end in mind, is where does that number get built? And it becomes a pre-tax versus post-tax question. Pre-tax always sounds good. We're going to talk a little bit about 401k plans and some of the opportunities to set money aside. But what ends up happening in life oftentimes is people don't equate the difference between assets and income. Whenever you have income, you're paying a higher tax than if you have an asset. And so what I think is interesting is people will sink a lot of money into their 401k plans and anything pre-tax while they're working because it makes sense that you want to save pre-tax, save on taxes now. The problem is you're creating the tax time bomb for down the road somewhere where all of a sudden when you want to take money out, that distribution becomes a taxable event. And when you do it big enough, it becomes a problem. So let's say down the road, you have $5 million and all 5 millions in 401k plans. I actually see this enough to say that this is not an anomaly when I say it. If all 5 million's in a 401k plan, your only option is to go into higher tax brackets to spend more money. Versus if you have some money in a 401k plan, but then some money outside of it in brokerage accounts, HSA accounts, Roth IRAs, just things that are going to get taxed less or even not taxed much. I think you have a much better opportunity to manage that tax bracket. So the problem with this is you got to start really early. You can't make this decision when you're 55, 58 years old and say, oh, now I'm going to start thinking about this. You have to start earlier than that in many ways, or you're kind of stuck with what you got. In an ideal world, I'll say, we would like to have about a 50-50 mix between these two kinds of assets. 50% of your total wealth maybe in a 401k plan, but 50% outside of that. It doesn't happen a lot, but I'll say that that is something that you should strive for because it's going to give you much more tax control long term. The third thing to consider when you start with the end in mind is everyone talks about Social Security not being there, but the reality of it is that even if they change the dates and extend it out a little longer, which by the way is on in the cards with Congress, um, the reality is at some point most of us are going to start picking up Social Security, whether that be at 62, 65, 70. These things will shift. But I think what ends up happening is people don't understand how big of an impact Social Security has. So I put a number to it. Your personal Social Security account, if you just look at it from the standpoint of taking the maximum payable here in 2024, you can get 3,000 if you qualify for the max, and that's a different issue, but $3,822 a month. Add 2% cost of living increase every year to that. Basically, your Social Security is worth $500,000 to $800,000. Just depends on when you die. So we just said somewhere between age 80 and 90. But from that standpoint, that's a lot of money. And so people don't think about the pile that is. And sometimes that's how I like to think about it in a total net worth standpoint is we have all these assets and oh, by the way, another 500,000 in Social Security for each person, maybe. So that's one big deal. Now, the other side of that, and I'm going to talk about it a little bit down the road, is there's a way to max out your Social Security, and that's whether or not, on my first bullet point here, wages versus distributions. What we see a lot is that people want to use S corp status to try to keep taxable income down, and they end up hurting themselves on Social Security. I'll touch upon that in a little bit, but that is an issue. My final point, in starting with the end in mind, is a point I kind of already hinted at, which is this concept of income versus assets. If I could teach a high schooler, instead of these classes in high school about the stock market game, I would actually rather teach them about the power of income versus assets. Typically, I don't think enough people understand this because they tend to spend most of their life trying to build income instead of building assets. And so they end up with a lot of income, but income is taxed higher. Whereas an asset, if you sell it, you got capital gains taxes, but those are lower. And so from the standpoint of income versus assets, I think this is a bigger deal than people give it credit for. The second thing is that assets can be given to the next generation. Income can't really, usually. And so I've seen people where they say, well, I've got this kind of income, this kind of income, this kind of income, which might be a bunch of pension plans and Social Security and stuff like that. And they're living a really good life. But then when they die, their kids are going to get almost nothing because they didn't save anything else. And I think that is one of the drawbacks to income over assets. So the third is assets can get a step up in basis. And that actually is a big deal. If you pass an asset on to the next generation, under the current estate tax rules, they get a step up in basis, which means the capital gains all go away on the date of your death. And whatever the value of that asset is goes to your kids. So that's a big deal for them. They can kind of wipe the slate clean and move on. That doesn't mean there's still not estate tax issues potentially. There could be. But to get rid of that capital gain is kind of a nice deal. The fourth thing is something I'll just throw out there because I've seen this a lot. People with assets can actually, in a very tax efficient manner, borrow against them and live a very good life. If you think about the most extreme scenario of this, it's Elon Musk. Elon Musk has tons of Tesla stock that he borrows against for his living. He doesn't ever cash it out. Now, somewhere down the road, what's going to happen is Elon Musk will die And then whatever he owes the banks, because he borrowed against that stock, the stock will have to be liquidated and pay back some of that money he borrowed. But the next generation gets a step up in basis on that stock anyway, so they wipe out the capital gain. So for them, it's a good deal. I've just seen over time that the way to leverage a balance sheet can be very important in life. And so I've tried to talk more about assets versus just income. This gets into play, by the way, though, when you start thinking about how to build a portfolio just broader than what we're talking about today. Because what I think a lot of people do is they try to build portfolios for income when they really should be thinking about total return. You can always sell a few assets to get some extra cash. I think income is a little bit nebulous at times. So let's move on to issue number 3. Let's talk about some of the specific strategies to consider that affect you personally. So this is a little bit about the business, but a lot about you personally. The 5 things I'm going to talk about are setting up a retirement plan, because this is the most basic answer, but also one that we surprisingly still don't see everyone doing. Second is the benefit of health savings accounts. Third is diversifying, which is going to be, this is different, but it's diversifying your risk because insurance comes into play. The fourth is that Social Security question, how to build it as opposed to hurting yourself with it. And then fifth is about taxes. So let's talk a little bit about each one of these. First, setting up a retirement plan. I'm just going to talk about the typical plan, which is a 401k. There's plenty others. Actually, in my next slide, I'll mention one other, but there's other stuff out there. But typically, this is what I want you to understand. In a typical 401k plan, you can set aside $23,000 as a individual. And then if you're over 50, another 7,500. Now there's a new rule that was passed in Congress. So starting January 1st of 2025, that 7,500 actually turns into 10,000 for people between ages 60 to 63. But then on top of it, if you're a business owner, if you plan well, and this becomes a planning issue, you got to have a good 401k advisor on this. You can put up to another 43,000 in from the corporate side, and we call that a profit sharing contribution. And so their total is 73,500. That's a big number, and that's a way for business owners to get way more in than the average person. And so from a long-term perspective, you can pile up a lot of pre-tax money. Now, I'm obviously going to argue you should be doing other stuff too, but this is a good tax savings opportunity for most people. My second point that I want to throw on there, though, is the biggest thing that's come around in the last few years is this idea of a mega backdoor Roth. This is a unique opportunity inside of a 401k plan. Well, let me back up. A lot of people have heard about Roth conversions in IRAs, where you convert money from an IRA over to a Roth IRA. And in that conversion, you pay the tax, but then the money goes into the Roth, and all of the money in the Roth now grows tax-free the rest of your life. And when you spend it, it's tax-free. Well, more recently, that's now doable inside of a 401k plan as well. But the issue is the money that goes into that mega backdoor Roth idea, you have a couple of specific issues. The 401k plan has to allow for it. So the documents have to be amended to allow for Roth conversions inside the plan. And I'll tell you, most plans aren't amended for that yet. But if you're the business owner, you can rightfully change the plan whenever you want for that kind of stuff. So if you want to amend your plan, it might cost you a small fee, but it might be something to consider. And the second part to that is what you want to do in that backdoor Roth is you want to basically do it on money that you put in on an after-tax basis. Because what you're trying to do is you're trying to not use the pre-tax money, because that hasn't been taxed yet. If you can add more money if you want to into a 401k, but it goes in after tax, and then convert that to the Roth and now that money grows tax-free. So on the front end, you're not going to get any growth in the first year you put it in anyways. Converting to that mega vector Roth, you could convert a lot of money. Let's say the profit sharing contribution wasn't doable for you, but you just put that money in anyways on an after-tax basis. That's potentially another 43,000 you convert into a mega backdoor Roth. That could be interesting. So I'm telling you, this is an idea that can potentially work. It doesn't always work, but it's something to consider because it is something that is more interesting these days. The second plan, and I throw this in there because this is a bigger deal, is pension plans. Now, pension plans are, if you think about it, we all think about these from the standard, standard old pension plan, the big company with the pension. But business owners can do this. And where it works really well is when you have a population in your business that typically you have younger employees, and then you, the owner, is probably the older person. Maybe you got other older person, but the issue here is that you basically are going to contribute to this thing based on how many years you have left to work. So the younger people get less money because they got a lot of years to work. Whereas you, since you only have a few years to work, you can put big amounts into this thing because you're trying to fund it fast. Now there's all kinds of other rules. I'm simplifying this, but for the most part, that's the interesting part to this. We've seen people who are putting in six figures into these plans every year because it works for them. And that can be a way to kind of fast fund your retirement. The negative side to these is you don't get to just decide to do it one year and skip the next. You can't do that. Like if you're going to set it up, the IRS wants to see you using these things. So what I would argue with most people is if you set it up, you better plan on funding it for the next 5 years. Otherwise, something like this probably doesn't make sense. So be willing to be diligent about it. The second idea I just want to throw out there is health savings accounts, because what I see in the health savings accounts world is even if you have these things, people aren't always using them the way I would hope they would. So what is a health savings account? Basically, what a health savings account is, it's just a bank account, could be a brokerage account, that's paired up with a high deductible insurance policy. So instead of your standard insurance where you have a $30 copay, you're going to have like a $4,000 deductible or some number on these high deductible plans. Now, if you're healthy, generally healthy, your family's generally healthy, this is okay because you probably don't have a ton of out-of-pocket costs throughout the year. But this is where these health savings accounts come into play. So in 2024, I'm going to go with the family number. A family can put, and let's say you're the business owner, you could contribute from a family standpoint $8,300 into this, and then if you're over 55, you can put an extra 1,000 in, so 9,300. I'm going to give you one more tip. What people miss most of the time is that $1,000 catch-up contribution for 55 plus also counts your spouse, but most people skip that part. So your spouse, when they are 55 plus, can also do $1,000. The issue is if you've got a plan through work, the plan isn't going to allow that. And so what you do is you set up a second account for your spouse and just contribute $1,000 to it. It doesn't matter if it's with the same provider. The issue is simply that the IRS recognizes you're allowed to do it. So once you and your spouse are both 55 plus, you can both do the extra 1,000 separate accounts. Now, the beauty of the health savings account is that the money does not get taxed. You can grow it tax-free. And as long as you use it for qualified healthcare expenses, you can spend the money tax-free down the road. So basically, if you think about it, this is a triple tax-free event. Put the money in pre-tax, so you're never taxed on it. It grows tax-free, and you spend it tax-free as long as it's healthcare related. Here's a couple of interesting things that people don't always pay attention to. Healthcare related is the issue. There's no time frame on that, however. So what I tell clients to do is When you go to the doctor throughout the year, just pay out of pocket. Don't touch your health savings account. Pay out of pocket. At the end of the year, you can always decide to do different, but you could also decide to do it 10 years later. So what I tell people to do is pay out of pocket as much as you can through life. Save all the receipts. Put the receipts in a folder. At the end of the day, 20 years later, let's say you had 30, 40, $50,000 of out-of-pocket cost, you could turn all those receipts in and take the money out of your health savings account because there is no time limit on that. So from our standpoint, I like when people do that, invest the money in their health savings account because it's growing tax-free. Down the road, if you do want to pull out a chunk, you could. But the other side to this, and I don't think people think about this enough, when you get to retirement and you jump on Medicare, Medicare doesn't cover certain things. And one of the main ones I'll tell you about is teeth. So most people, when they get into retirement, have teeth issues and hard teeth issues, like start getting into bridges and all this stuff. Like you're talking $15,000, $20,000 at a pop. So if you have a health savings account, it can be helpful. Or if you have the other things you could do is just use it for other deductibles and things like that. So it's money you can use. The interesting thing is we're starting to see health savings accounts with six figures in them. People are actually have been doing this enough now that they're growing and they're becoming popular because you can't invest the money. It doesn't have to stay in cash. So people invest it in mutual funds and let it grow. On the back end, here's the back end problem. The back end, you get a diagnosis of that's terminal, and you're going to pass away. If your kids inherit this money, they actually could get taxed. So you want to spend it up while you're living. And I think not enough people as they get into retirement. I think our natural tendency is to just keep hoarding money and say, well, I'm going to just keep saving, 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 saving. No, there's a time when you actually should start spending. And this is one of those accounts where it's fantastic building this money tax free. But you do want to start spending it at some point. And I do think that point starts, probably around 65 when you start having Medicare kick in and some other supplemental insurance and things. You can start paying for some of that with this. It's a small dollar amount, I get it, compared to a big business, but I don't think people realize how much small dollars like that can add up over 10, 20, 30 years. Now, let me talk quickly about diversifying risk. This is not about just investing. And I'm going to specifically jump on one thing. I'm going to talk about specifically disability insurance in a second. The rest of this stuff is all things people should deal with. And here's what I see most people doing for no better answer, probably incorrectly. I think in the business, I don't think enough people spend enough time thinking about what their liability insurance should look like, and or if they should have some kind of business interruptions insurance. Some of us can just go online, I guess, like during COVID, just go online and we can operate just fine. But there are others who might have, physical plant and things like that. That business interruption might become a bigger issue. I'll just bring that up because I see that missing a lot. The second thing I'm going to bring up just before I dump into disability that I see missing a lot is on the auto home side. Everyone deals with life insurance and health insurance. And as you get older, you might talk about long-term care. People pretty much avoid talking about their homeowners, their car insurance, whether or not they have a good umbrella policy, things like that. It's kind of aggravating actually for most people because at least right now, all they see is huge premium increases. And it's kind of that use it or lose it rule. You don't really care about it until you actually need it. But this is where people should actually be spending more time. And when I say more time, this needs to be reviewed annually. And really, you need to go in depth on some of the questions because I don't think people realize how much personal liability they can have when this isn't set up correctly. And they don't know it until they get in a car accident, their kid gets in a car accident, whatever. So I'll bring that part up. But I want to talk about disability because I think disability gets ignored by most people. And I bring it up because disability insurance in and of itself is, again, it's like use it or you lose it kind of thing. Like most people don't want to talk about it, but the reality is you have a better chance of becoming disabled than you do of dying in any 1 year. I think it's about a 1 in 3 chance. Disability is actually a pretty big deal. And it's important because if you're the, if you're a, let's say you're a partner in a business, but if you became disabled, you get bought out of the business after 6 months or a year or whatever your documents say, like you could lose all your income. Now you might still get a buyout number, but it might not be as big as you thought because you got sick early in life, right? I've actually seen this. I have a seen scenario. I can talk about a scenario I saw where someone who basically was in a job that's all about thinking, was doing a weekend project, hit their head, and just like that, the rest of their life they can't do their job because they can't think the same way. So this is a big issue. What I want to talk about with it is the way disability insurance works is that they're never going to let you um, put insurance on your entire income. The maximum amount you can ever insure usually is 60% of your income. And then there's all kinds of other little rules, but let's just say that 60% of your income. Okay. The problem that I see is that a lot of times people will say, I'm going to have the business just pay for that. That's the wrong answer. The right answer is have the business use the cash in the business. That's fine. Put the premium payment though on your tax return. You want to actually be taxed on that premium every year. And the reason for that is on the back end, should you ever need the benefit, if you pay taxes on your premiums, the benefits are tax free. If, on the other hand, you didn't pay taxes on your premiums, the benefits are taxable. And that's a big deal. So I want to run through this example. Let's pretend that you basically purchased a policy on your income. And I'm just, for ease of use, I'm saying you're in this scenario, your income was $13,000 a month, 13,333. 60% of that is $8,000. So you're already going to get less. But if you think about it, that's okay, because if we make this tax free, the difference between 13,000 and 8 is probably what you're paying in taxes anyways. So you're going to get $8,000 a month. Okay. That's reflected here in the after-tax income. Let's pretend, however, that you screwed up and didn't have the premium taxed on your tax return. 8,000 actually on an after-tax basis is now 6,500. So just like that, you lost $1,500 a month, which is a lot of money, quite honestly, if you were disabled. Now let's add one thing to this, because this is being taxed in a lower bracket. Let's add the fact that now let's pretend you have a spouse who has 10,000 a month in income coming in as well. What that does is that income plus the fact that you would be taxed on this 8,000 actually pushes you into a higher tax bracket. So what I wanted to just show here is you actually lose an extra 500 a month to a higher tax bracket if you don't do this right. So I just bring it up because this is a big deal. We see this mistake all the time. So that is one issue. And the tax consequences are in yellow here. What really you thought was 60% disability insurance actually on an after-tax basis can drop to 40%. Can any of us live on 40% of our income? Probably not. So if you take anything from this today and you deal with disability insurance, please look into that. Now, jumping into this idea of Social Security and salaries, I want to jump into this concept of what happens with S corps, because so many businesses are set up as S corps. I'm only going to spend a minute on this, but here's the issue. Most people, when they have S corps, are trying to they have an option of how much money to pay as salary versus how much to take in distribution. The benefit, of course, is the distributions are not subject to Social Security tax. The negative to that, though, is if you're not paying Social Security tax, you're not getting the ultimate benefit on the backside. And Well, a lot of people seem to think this isn't a big deal because they're not thinking longer term. What happens if down the road you became disabled in some way, your health went bad, or you just sold the business for a lot less than you thought you were going to get for it? Social Security could become a bigger part of your world than you think. And so what I see oftentimes is people are trying to think short term and save a few $1,000s in tax today. And what they end up doing is they're cutting out, as I said, if Social Security is 500 to 8,000 or 500 to $800,000 pile, they may be cutting a few $100,000 off that pile. That's, to me, that I'm not sure if that's a trade-off I want to make, only because I always think in risk-adjusted terms, and I'd rather pay a little bit now to dampen the risk in the future. So that's kind of how I'm thinking of this. And here's part of the other side to this is that the way Social Security works is, you get your benefit, but your spouse is going to either get 100% of their benefit or 50% of yours. And when I say spouse, it's either direction. Okay. So both spouses get this option. But basically, let's pretend that the business owner is the only one working and the spouse is the stay-at-home parent. The spouse is basically probably not going to earn a lot of money. So 50% of this number is probably going to be the better answer. The second part to this, by the way, is let's pretend this person dies. The spouse actually gets to jump back up to this number. They don't have to stick at this number. Again, that's why I like to max this out as much as I can, because I'd rather have this guarantee in place for the spouse. Now, that's a big reason when we talk about S corps that I would advocate people pay slightly more to max out their Social Security numbers. I'm not going to get into all that because that's a lot of detail, but there is a number out there that people should be, comping themselves at to make that work. Somewhere in the neighborhood of 75 to 100,000 is generally the number at a minimum. But I just want to bring that up. The second piece to this, though, that's interesting is if spouses are working together, what I see oftentimes is in order to save some money on Social Security tax, they pay the second spouse nothing. Actually, this gets into this question of which is greater. If you do solid planning, you might actually want to pay your spouse something and yes, pay Social Security tax so that they then max out their benefit, because on the long run, this could add a big chunk of money to the family pile down the road. So it's a different way of pulling value out of the business, but I want you to at least think about it and talk to your advisors about it. All right. Finally, let's talk about taxes. Taxes are an interesting point. If you look at it, timing income and deductions is probably one of the best things you can do in a year. And when I say timing income and deductions, we don't get to just randomly decide maybe not to take income if we actually have income. But sometimes there's an ability to accelerate income into certain years where you have a problem. For example, in 2008, when we saw the real estate debacle, we saw several companies that basically went from decent income down to almost nothing overnight. And in those years, those kinds of people, if they're going to have very little income anyways, should consider maybe doing a Roth conversion or some other way of accelerating income into very low brackets. And in some cases, I saw zero brackets. I saw people's businesses derive negative income. Well, we could do a Roth conversion for nothing then. But if you don't pay attention to that or think, well, things just stink and I can't do anything, the answer is, well, maybe you can. So I bring that up because accelerating income actually is an interesting strategy sometimes. And the other one is this deduction idea. We can time some deductions, some we can't. I mean, sometimes you just got to take what you can get in a year, but deduction bunching is actually an interesting strategy, and particularly with charitable giving. I think too many people contribute to charities year in and year out the same amount. I'm going to, someone says, I'm going to give $5,000 to the church and I'm just going to do it every year for the next 20 years. I'd rather see them, using the right tools, of course, but I'd rather see them give 25 or 50 or $75,000 to the church all in 1 year, because now they get to deduct all that against whatever else is going on in their income tax stuff. Now, the way to do it, just as an aside quickly, the way to do it in a way that makes it doable is you use a donor advised fund. And then you can put it in, take the deduction, but you don't have to hand it all out to the church all at one time. So it does give you some leverage. I'm not going to get into that because it's a whole different discussion, but there are ways to do this. I just want to bring it up because I think a lot of people question why they should be thinking outside the box. And I always tell people, if I were you, I would pay whatever extra money your accountant wants every year to have these conversations, because I think there's a lot of stuff that gets missed when people don't. All right, finally, let's talk about preparing to sell your business. The succession plan needs to start at least 5 years before you plan to sell the business. Now, ideally, it starts before that, quite honestly, because what I've seen is there's a lot of people that strike out on the first, second, third try before they kind of hit it. But 5 years is kind of a minimum. Like, if you're not thinking that far in advance, the reality is you're not going to probably get the most value out of the business. Here's the things you got to think about when you start that far out. You want to first do a margin analysis to figure out what parts of the business create the most margin. Because what you really want to think about is whether or not you should cut some of the business lines that aren't creating a lot of margin. A new buyer wants to see the most efficient business. So they don't necessarily want to have a lot of, the junky stuff laying around. Now, sometimes they view it as, I'll come in and fix all that, sure. But it's better if you can deal with it, because what I've seen is, if you as the seller show up at the door of the buyer and say, I really know my stuff, I think the buyers oftentimes pay slightly more. So a margin analysis early to understand where the opportunities are is a big deal. Secondly, then, are there services that you actually should add? It's not just cutting. Are there services you should add that can be complementary, that might even have higher margins, that kind of thing? Because again, buyers like to see that the business is actually in an active growth phase, as opposed to just getting by. And if they think the seller is just dumping the business because they just are exhausted, sometimes buyers get a little nervous at that. The third thing is changing the client base. I don't think enough businesses do this, but I think that focusing on the client base and the makeup of the client base and what's going on with that customer is a big deal. If you don't constantly evolve a bit on this and say, the kind of, we're moving upstream in a customer size, or we're moving downstream, or all these different things, I think that can actually also play into this idea of is the business evolving and growing. The fourth is technology. Quite honestly, too many businesses don't invest enough in technology. They invest in a piece of technology, but they don't go deep in it. So they might say, well, let's say I've got Salesforce, but then they don't actually use it for anything except for storing phone numbers and addresses. If you're paying a lot of money for Salesforce and that's all you're using it for, it's not really the technology. It's just a glorified spreadsheet. So I think going deep on technology and process is a big deal. Again, if you can prove to a buyer that you have an extremely tight process that generates efficiency, therefore they don't have to hire more employees to make that profit, that's a big deal. And then finally, I think enough companies don't focus in on the management side of this and how to institutionalize things. Building a business is oftentimes the question of ego. It's the personality. The personality-driven business oftentimes grows very fast. And what kind of gets to the downturn, or I would say the negative side to selling the business, is that if it's a personality-driven business, it's actually worth less because that person's leaving. So I think companies should be focusing earlier on in their stage on how to institutionalize things. Sometimes that does mean bringing in more professional management from, CEO all the way, CEO, CFO, chief marketing officer, all this stuff, because you want to institutionalize. Within that 5-year period, and hopefully earlier, you think of it from the standpoint of a succession plan as well. I think the interesting thing is when and I say we because I'm there too, in our mid 50s, I think we know so many people that we can actually leverage those relationships, and our younger employees can't do that yet. So we need to stop being the doer and start being the teacher, and then leverage the relationships to help the business grow, but grow in different ways. It's not just about growing in income, it's also about the wisdom we now have to build out process and training, employee training, and all kinds of stuff. We need to become that teacher. If we're still doing it, especially later years, as we approach mid 50s to 60, we've basically given up a huge opportunity to add more value to the business. It's that simple. And any buyer does not want to see you doing the work. They want to see you as a little more of a figurehead in some ways. So how do you give the employees that process and roadmap is a big deal. Again, I don't think enough businesses focus on that. The shareholder agreement, I'm going to end with this. So if you have questions at all, please throw them my way. At the end of the day, the shareholder agreement, if you have partners, is an issue because the shareholder agreement is going to spell out a lot of stuff. And what I've interestingly found is a lot of businesses don't have a shareholder agreement, even when they got a lot of partners. So I think this is a big deal because when you get into the dispute side, it becomes very clear that there's issues that weren't addressed early. So how decisions get made should be in there. What's the valuation of the company? There should be some way of valuing the company because when it comes to selling, let's say you decided not to sell to an external source. Let's say you decide to sell internally to your employees or sell to your minority partners. There has to be a valuation methodology. If you can agree to that on the front end, that's a much better answer because then people will trust that that's the right answer as opposed to second guessing your motives. That goes a long way in getting a deal done. The third is tax issues. Again, we see problems where businesses are selling and they're taking it in getting income treatment instead of capital gains treatment, stuff like that, because they just didn't do the right thing in the front end. The fourth is what happens with the change in leadership. Again, you can spell this out in documents. This could be if someone got had a health issue, something like that. But there also could be some other things that come up should there just be a general change, like a shareholder that wants to sell out. And then finally, the general legal structure, which I'm not going to jump into that much. Really, what I'm telling you is shareholder agreement's a prenup. And we should all sign that shareholder agreement while we still are happy with each other and excited to be together, because at the end of the day, that is a big deal. It's going to drive things better. My last point on this is I like this. I know some people don't like this, but I do like it. I like mandatory retirement ages in shareholder agreements. Now, the reason I like it is because I'm not trying to say that everyone's worthless, but there's plenty of information out there that talks about how our brains slowly lose capacity starting around age 50, early 50s. We're losing some percentage of our capacity from that point forward, which means we inherently become slightly more risk averse, as well as our decision making makes us more confident or overly confident. So then when we make mistakes, our mistakes are bigger. Now, when I talk about this from the perspective of an investment portfolio, this is a big deal because people make bigger mistakes and they think they're right, they're overconfident. But this comes into play in business all the time. So my preference is to get business owners to think about how they start working their way out and handing the business off to the next generation earlier, like already in their mid 50s, so that they're around to help pick the next generation up when mistakes get made. They're around to help with their wisdom. They're around to help and be a teacher, not the doer. Yet at the same time, they're giving the next generation the opportunity to succeed. Because at the end of the day, the next generation isn't going to stick around if they don't have that opportunity. So really what this becomes is a talent play. The most talented people will only stick around if they see you at the end of the tunnel. And so pushing for that a little quicker I think is a smart thing. So I like mandatory retirement ages. Could be 65. Um, I've seen that in documents. Age 65 is great. But really what that means is by the time you're 55, you should be thinking about, okay, how am I going to start this transition process? And I just don't see enough businesses doing that these days. It hurts their talent pool, and in the long run, it hurts their business because they're not making the decisions early enough. They're thinking that they're the answer. So that's my hot take for the day, if that's a hot take. With that, I'll just recap. We had 4 parts to this today about why I think you should diversify business wealth, because I think along the way, we all are going to run into health issues and other issues that come into play, including keeping our spouses happy. Second, start with the end in mind so you actually know what number you're shooting for. I think having that goal is important. Third, there were some strategies I wanted to bring to the table. And then fourth, there's a bunch of steps you should be taking along the way that are to some degree soft steps. There's not always the clearest answer, but I think the selling of your business really starts 5 and 10 years earlier. So if I can encourage anyone to think that way, that's a win today. So with that, I want to thank you all for attending. Again, you got 10 seconds if you want to throw a question at me. But from the standpoint of our next hot topic in April, we'll be doing a quarterly wrap up of the economy and the markets on Wednesday, April 24th. My compatriot, Chad Helber, will be joining us for that one. Chad runs our trust company. So we will be jumping on together as we did in January. So welcome to join us. At this point, I don't see any big questions. So at this point, I will hand the day back to you. Thank you for attending and have a great day. Bye-bye.